Good afternoon, everyone. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in the market. We're a few days into COP26. Many global leaders are in Glasgow at the moment, and their discussions could have broad implications for the energy sector. I'm personally skeptical that we will see a grand top-down kumbaya kind of moment, but I think that the kinds of discussion could lead to bottom-up type policies that may have a meaningful impact on the sectors we cover over the next 5 to 10 years. And so with that, I want to kick off for the discussion today with Will Hares. Will, you put out a note just last week looking at COP26 and the European oil majors. The title of the notes, COP26 may turn up emission spotlight on European oil majors. You can find it on BI Go. But Will, tell us the crux of your thesis.
Yeah, thanks, Rob. So our general thesis is probably not that surprising, in that these European oil majors are really major emitters in the global sense of climate change, and we think that just generally the COP26 is going to be shining a spotlight on these oil majors, their operations, and in particular Scope 3 emissions, which is the indirect emissions comprising the vast majority of these companies' emissions profiles, and these are the emissions that originate from the combustion of their products, so from the tailpipes of cars. Now, for the European majors, there is some benefit here. These companies have announced increasingly ambitious emissions objectives over the past 24 months or so, with each of the Europeans outlining various iterations of achieving net zero emissions from a full Scope 1 to 3 basis by 2050. So this would be aligned with the Paris Agreement, and one of the key objectives of COP26. And I think it's also just worth mentioning that there is a major strategic disparity in view between the European oil majors and their peers in the U.S., so Exxon and Chevron, which have thus far declined to outline and pursue anything close to the emissions objectives that we've seen from the European majors. And I think the main takeaway from this is that's very clear, is that the American majors are not intending to evolve their product mix meaningfully in any way away from oil and gas. This is the key lever that these companies must pursue in order to reduce their Scope 3 emissions, is gradually move from oil to gas and eventually electrons to achieve net zero. There is no viable pathway to achieve net zero emissions by 2050 without pursuing some sort of evolution in product mix.
Thank you, Will. We'll come back to you in a second. I want to bring on Salih. Salih, you just heard Will talk about the idea that the European oil majors have a very different take on the energy transition discussion than their counterparts in the US. Give us a sense of what companies, national oil companies in the Middle East, are thinking as they approach the issue of climate change. And I want to bring up an interesting point here. On the one hand, you've got folks in Glasgow talking about reducing emissions, but US President Joe Biden was just asking OPEC to produce more oil. How do you reconcile these things? How are folks in the Middle East really thinking about this problem and balancing that near-term question with these longer-term goals?
Sure. Thanks, Rob. I think these are very good questions. And on the first part of your question, I think Saudi Aramco is a good example of a listed company that we have good information on and good kind of insight into the policy of Saudi Arabia as well. And what we're seeing there is, I mean, you may have seen the last couple of weeks, Saudi Arabia did actually pledge to be net zero emissions by 2060. And obviously, Saudi Aramco is the sole oil producer in Saudi Arabia. So this has obviously huge implications for what Saudi Aramco will look like by then. And again, I think there is a lot of skepticism around this net zero pledge, and there was similar skepticism around the UAE pledging to be net zero by 2050. But I think, I mean, there are certain things they can do. Obviously, solar power generation is a huge potential for them, and this pledge is only for within their borders. So I think there is, so obviously, as Will mentioned, Scope 3 wouldn't be included in this. So it's arguable whether they can achieve this or not. But at the same time, I think it's important to look at their near-term strategy, because their near-term strategy for Saudi Arabia and for Saudi Aramco is actually to spend billions of dollars to increase their oil production capacity from 12 million barrels per day to 13 million barrels per day. So clearly, they're not too keen to completely change their product mix just yet. And clearly, they're seeing the rest of the world, the international oil majors, kind of, as Will alluded to, shifting their focus and shifted their spending away from oil and gas. So in the near to mid-term, in the next decade, they definitely see this kind of room for them to come in and grab that market share and be more relevant. In terms of your second question, I think this is also a very interesting question, because we do have an OPEC meeting tomorrow, and we've kind of seen pressure from President Biden, from the White House, and actually from Japan, China, and other oil-consuming nations as well, that current prices are too high, and they would like OPEC to increase production to kind of help ease those prices. But it looks like OPEC is very unlikely to respond to that. The expectation is very much for them to stick to the initially planned 400,000 barrels per day increase for December. And what they're saying is, look, actually, oil price hasn't really been going up that much recently. I mean, it's kind of, according to them, stabilized between $80 and $85 a barrel. And they're saying this tightness in the market in the next month or so is not really due to oil fundamentals, but it's because of switching from natural gas, switching from coal, because the fundamentals in those markets are much tighter, and that switches are happening, especially in Asia. So I think, again, OPEC sometimes does surprise the market, but in this case, it looks very unlikely that they will change their course.
Thank you, Salih. One of the really interesting statistics I just saw this morning, I was talking with my friend Nat Bullard, and we like to exchange tweets on things that look different than the past. And one of the things that he highlighted is that about 30% of vehicles, light-duty vehicles in Germany that were sold in October were plug-in. So that's pure BEVs plus plug-in hybrids. When you think about the future of the oil industry, what's the sense on how quickly the transition to EVs are going to be? What kind of oil demand outlook could unfold when you see numbers like that? And I'll come to you first, Will. Give us your read on the tea leaves as you think about the energy transition and light duty transportation. How quickly are we going to replace oil molecules with electrons?
Well, I can say from an oil major perspective, at least in Europe, I think it's pretty clear that they are planning and expecting for peak global oil demand to be reached within the next 10 years. And we're seeing this manifest in their strategies. So there's only two of the European majors that have not begun to decline their oil volumes already. And all of these companies are planning for a significant change in weighting of their production mix over the next 10 years. Total just recently said that they expect less than a third of their product sales to be oil by 2030. That's a big change from majority right now. We see BP aiming to decline its oil volumes by 40% over the next decade, and Equinor will begin to decline their oil volumes from mid-decade as well. And keep in mind, this is going alongside a rapid build out of renewable capacity across each of the companies. We expect to see continued M&A in this arena. We just saw some yesterday with Eni farming into a further 10% of Equinor's Dogger Bank, which is the largest offshore wind farm in the world. It's located in the UK. So this trend we expect to extend and strengthen, and as I mentioned before, I think just goes to re-emphasize a vastly different strategic direction that is being taken by all of the Europeans as opposed to that in the US.
Patricio, I want to get your reaction on this as well. Are the electric utilities excited about the potential of a new demand source from electric vehicles? And what are they looking for out of the COP26 meeting?
So I think in the broader sense, it should not be a surprise that good positive read across from the COP26 would be more stringent and accelerating green targets, emission reduction targets. These are likely to percolate into more ambitious investment plans, which kind of see the larger integrated utilities, which have an embedded growth pace of about 10% a year for renewable deployment of both wind and solar. We could see an acceleration of those on the back of COP if these pledges actually do materialize into some sort of policy that translates into bigger, larger taxes for more carbon intense production. So this is a trend that's been already going on for the past I'd say 5 or 10 years, but we still see some room to accelerate that further. And on the other end, you have the renewable pure plays such as Ørsted and Acciona and all the smaller sort of players with massive development pipelines that are actually almost twice as ambitious as the larger integrated utilities. But we see a positive backdrop from COP26 for the visibility of those pipelines and actually materializing that earnings growth, I'd say until at least through mid-decade.
Very interesting, Patricio. So maybe not to put words in your mouth, but I hear a vision for what the utility of the future could look like from you. From Will, I hear a vision of what an integrated oil company could look like over the next 10 years. And now I want to turn to Salih because one piece of your coverage is the European refiners. And you took a look at how the refiners may fare under a net zero scenario and some of the kinds of thinking that's being discussed at COP26. So, Salih, tell us about refiners. How does their future look in this type of world that everyone's talking about right now?
Sure. So, I think we have a short note on what COP and some of these green deals might mean for refiners. And the thing is, the long-term risk for refiners have been there for a while now, and these pledges kind of bring that uncertainty around fuels demand and refining margins for them just forward. And I think what we will see within the refining space is the survival of the fittest, right? Because we have a lot of refineries around the world, some of them quite old, that hasn't really been kind of gone through any capital cycles and aren't really flexible with what types of crude it can take, and not really flexible with the type of oil products that it can produce. So I think, and when we think about the net zero world, I mean, again, we always refer back to, as a scenario, the IEA net zero scenario. And what they see in that scenario is about 85% drop in refining throughput by 2050. Again, you could argue that this is an extreme scenario, but it's obvious, I think, that the global refining throughput, the refinery run levels globally will fall. And as it does, I think the newer ones, the more complex ones, I mean, we have a lot of refineries that are being built in the Middle East or in Asia, will obviously be the best positioned. And I think within these refineries as well, the ones that are flexible enough to kind of react to demand dynamics in terms of products. For example, given the increasing demand for petrochemicals, the ones that can focus on the lighter end of the barrel will be able to kind of grab a better refining margin, because it's all about refining margins, and it's all about the ones that can keep being profitable. And when we look at some of the older ones, they already were, some of them were already loss-making during the pandemic. They are trying to recover now. But I think, to your point, beyond the midterm and in the long term, there are a lot of challenges waiting for them.
Thank you, Salih. Very interesting take. Maybe to shift gears a little bit and a little in line with what you were just saying, but Will, I want to bring you back on to talk about 3Q earnings and what we're hearing in the very near term, probably quite different than the kinds of discussion happening in Glasgow. But what did 3Q look like? What lies ahead? And maybe one just very pointed question: how are the integrateds guiding on where CapEx is headed? Because I know we've seen a big pullback because of COVID. Are we seeing rebounds there? What are they talking about doing in the years ahead with their capital expenditures?
Yeah, thanks, Rob. So I think with this increasing climate scrutiny and sustainability risk, it's notable that the third quarter results for the oil majors were unsurprisingly very strong. We saw high free cash flow. Clearly, the upstream and integrated gas units from these companies are doing very well, capturing value from some of this multi-year high in pricing in oil and record high pricing for gas, at least in Europe. And what we think is that this is justifying upgrades in share buybacks, some of which we saw in the quarter, and we think that these levels will likely be sustained next year, and also increasing justification for further dividend policy upgrades next year. We note that both Shell and BP, their payouts are still at roughly half of pre-pandemic levels. Both Eni and Total have recovered their dividend to pre-pandemic levels, and Equinor is nearly there. But really, we've seen good deleveraging as well, and a real stabilization of these financial frames. So overall, very strong recovery for the sector. And we think that capital discipline is going to remain very strict next year. We expect relatively flat spending year over year. So still, 25, 30% below where the pre-pandemic levels of spending. And what we think this will facilitate is, further buybacks, as I mentioned, increasing scope for dividend upgrades, and of course, capacity to deploy into energy transition strategies. I think it's really important here to note that while there's extremely strong performance in the oil and gas units, records in some cases for some companies, the transition strategies for these companies are not slowing down or abating. If anything, they are strengthening as a result of this. And we think that we're going to see more of that next year.
Well, thank you, Will. One of the companies that reported just today is Vestas, and we've got a React out this morning. Looking at them, we've seen a relatively large pullback in their share price, and our view is that the fundamentals in the medium term actually look pretty decent. We think there's a potential turbine growth, sales growth opportunities, particularly out of the kinds of discussions that you're seeing in Glasgow. But one of the really interesting phenomena about the share price reaction is that there seems to be a bit of contagion with Ørsted and some of the other names that you covered, Patricio. So what's going on there? Do you think that, how do you see the fundamentals for the utility space, and what have you been hearing in your readouts from the 3Q calls?
So on the specifics for Ørsted, which I would put it in the category of a renewable pure play utility, there seems to be a correlation to these I think it was a profit warning from Vestas on the full year guidance. We've seen an otherwise solid set of three key results from Ørsted. The only caveat is that those were driven by their bioenergy unit, which has a sizable gas generation unit. So those kind of offset the lower wind speeds at the offshore level. So in our view, that means that steady earnings that de-risk the full year guidance, but they do highlight the increasing sort of earnings volatility that you see in companies such as Ørsted and all the other pure play renewables, which have these contingency on external factors such as the weather. We nevertheless believe that the growth story in Ørsted is still intact. There's nothing that says that they cannot up their midterm financial goals next year again. They've already revised their 2030 goal up to 50 gigawatts by 2030 from 30 gigawatts previously, just this past June, and we don't see any reason for that not to materialize, especially now that the company is expanding outside of Europe, which may help somewhat mitigate the weather risk of being concentrated in a single weather region or geography. And in terms of the rest of the utility space, we've seen a mixed effect of the commodity price inflation, with positive read-throughs for the legacy producers such as Fortum and Uniper and Ches, which have a higher emission fleet in general. So they have coal production and they also have coal generation and gas generation. So they've seen an uplift. But we don't see the sort of the structural story for them changing in the longer term, which is that they will have to pivot towards the renewable race and sort of compete for more renewable capacity, especially now that coal phase outs are imminent and probably will even accelerate on the back of COP26.
Thank you, Patricio. It sounds like some of the readout from your space and Will's space could have positive read across for demand fundamentals for the wind and solar manufacturers. But before we move on to the next topic, I want to let Salih weigh in here on earnings from some of his companies. Let's highlight Saudi Aramco. Salih, what are they seeing? How does it compare and contrast with what Will told us about the European integrateds, and are they even talking about any of this green spending or energy transition stuff that we've been discussing here today?
No, but as Will said, it was, in terms of the 3Q results, it was unsurprisingly pretty good. The net income was at slightly above $30 billion, which was just slightly above the consensus expectations. And the free cash flow was at about $29 billion, which meant it was enough to cover their quarterly dividend of $18.75 billion. And in terms of dividends, Aramco did actually stick $75 billion. It did actually come back down to about 17%, which is better, but still above the 5 to 15% target range that they have. And remember, Aramco had a net cash position only 2 years ago, so that's changed quite a bit. But behind the results, obviously the better pricing and higher output drove them, and in downstream. Refining margins are showing some improvement, which is something that we're seeing in the rest of my coverage over in Europe as well. Chemicals margins is obviously very important for them now because of the SABIC integration. And I think for this year, chemicals margins seem to have peaked in the second quarter, so that was relatively weak. But overall, it was a very good quarter for them. And beyond I should mention, and a quick reminder actually, that Aramco is probably one of the very few companies who can increase its output without additional capital spending. It's because as part of the OPEC Plus deal, they have been taking a certain number of barrels off the market, and as the tapering of these OPEC Plus output cuts goes on this year, Aramco is bringing back those barrels in as well. So I think they're in a pretty good position for the fourth quarter as well. And again, what they've done and what they've mentioned is that bringing gearing back down to the target range remains a priority. But given how strong the fourth quarter looks, I think a special dividend, which they've so far dismissed, may still be on the table.
Thank you, Salih. Okay, with a few minutes left, I feel like given that we're in the midst of COP26, we should also just take a quick look at the carbon market. If you look at IEA's net zero scenario, they envision a world with carbon above $100 a ton by 2030. That's in real 2020 dollars. And by 2050, they're talking about $250 per ton carbon. Are any of the integrated oil companies thinking about carbon prices that high? I know they have some internal shadow pricing on that. What's your sense on where they're seeing that market go?
Short answer is no. None of the European majors have internal carbon pricing anywhere close to $100 a barrel. It's around $40 a barrel, 40 to 50 right now. But I would imagine that there are conversations ongoing to incorporate a significantly higher carbon price over the long term within their economics calculations for their investment decisions. So it is definitely increasingly playing a role in these decisions for the European oil majors.
Excellent. Thank you, Will. Patricio, I want to come back to you on this one. What kind of carbon pricing regime are utilities envisioning here in Europe, and what's it mean for the coal phase-out plans that are underway?
For the most part, European utilities have robust hedge pricing structures for carbon, and most of them oscillate between 50 to 60 euros a ton. And this has hurt players like Ches and Uniper. That they will be hurt this year, but probably come out relatively flat next year versus the carbon price at the time. But if anything, this just highlights the speed at which the coal phase out is coming to fruition in amongst European utilities. So we would actually expect to see anyone who has a significant coal fleet to pivot potentially to gas production, which emits half as much carbon as coal as the first step, and then potentially pivot on from there to either some sort of hydrogen play, or perhaps get on board the renewable deployment train, which is likely to face more increasing competition and perhaps a bit of cost inflation due to that competition. So we do see that in the utility space that the COP26 may actually sort of widen the gap between the renewable haves and the renewable have-nots in Europe. So yeah, that is sort of my view on the carbon pricing piece for utilities.
Thank you, Patricio. Okay, one last thought, and we're going to go to Salih for it. Salih, you closed one of your focus ideas on Monday on OMV. Give us a 60-second pitch on what you had projected and